Hello, thank you for joining us. My name is Rodrigo Afanador of PropertyAnswers.com. I'm sitting here with Mr. Codington with Thomas Codington and PA, accounting firm here local to Asheville. Thank you for joining us. We want to take a couple moments today to address what we would consider frequently asked questions in regards to tax issues when you sell your house. I'm going to take a moment and just let Mr. Codington introduce himself, and that way you'll be able to get to know him a little bit. Mr. Codington.
Thank you, Rodrigo. It's a pleasure to speak with you today. I'm a CPA and have been in practice for a little over 30 years. I have a firm with 8 staff accountants, 6 of whom are CPAs. We don't do any auditing. We focus on tax planning, tax preparation, tax resolution for taxpayers that have problems, as well as some financial planning.
Okay. Well, that's great. So you definitely know what's going on in that arena. Thank you so much. Got a couple of questions. I think the basic one is that people want to know is when you sell your home, are there any benefits from a tax perspective?
Well, fortunately, Congress has given us an exclusion, and up to $500,000 of gain is excluded for a married couple filing jointly when they sell their home. Single person gets to exclude up to $250,000 of gain.
Okay. Oh, well, that's a great transition to my next question then. What is considered a gain, or give a brief description or definition?
Good question. The gain is really the sales price less the taxpayer's basis. Normally the basis is the taxpayer's original cost plus any improvements that he may have made during the time he owned the property.
Okay. And that's something that's going to be documented through their ownership history then, primarily?
Yes. Beginning with the closing statement, also known as the HUD-1 statement, when they first purchased their home.
Oh, okay. Great. When at that point when you sell the house, do you report those gains, or is there anything else you need to report besides the gains then?
Yes, the sales should be reported on the taxpayer's tax return for the year in which the sale took place. Once again, if the gain is less than the exclusion amounts, there won't be any tax, but it's a good idea to report the sale and the return.
Okay. Always better to be safe than sorry, right?
Right.
Okay. I know a lot of our viewers have the houses that they may be selling or are in the process of trying to sell have been used as rentals. Is that applicable, or is there anything that you should be aware of with rentals?
Yes, Rodrigo, there is a difference. When you sell rental property, the basis will have been adjusted by depreciation. A home's cost is deducted ratably over 27 and a half years in the case of residential rental property. So each year the taxpayer is able to deduct a portion of the cost through depreciation deductions. Those depreciation deductions reduce his basis, his original cost, and whatever that adjusted basis is after deducting the depreciation, that's what you subtract from the sales price to get the gain.
Oh, okay. And
that gain will be taxable.
Okay, so that kind of actually moves it perfectly into my next question. Obviously, nobody likes to pay taxes. What's the best way to minimize taxes if you are over that gain?
Well, in general, the best way to minimize taxes is to have very good tax advice for the taxpayer to engage a CPA who has experience, particularly in the area that they're dealing with. If it's a real estate investor, somebody that's experienced in dealing with real estate investors. It's also important to keep very good records and books, and certainly have all the documents available, and including any improvements that may have been made to the property, and that will help minimize the taxes on the sale.
Okay, well, in regards to keeping all this information, we're definitely moving into a digital age very quickly. Is there any difference whether you're keeping this information paper-wise, like in a tangible way, or is it something you're able to keep digital copies of?
You can certainly keep digital copies.
And what is the any time frame? Can I, toss it out 6 months after I sell it, or how long should I be holding on to this paperwork?
Good question. We recommend that taxpayers keep documentation for their tax returns for 7 years.
Okay.
And this is the reason. The general statute of limitations for the IRS to examine tax returns and make assessments is 3 years. However, in cases where income is understated by as much as 25%, then the statute of limitations is extended to 6 years. And of course, the due date of the return is several months after the year in question, so that's why we recommend keeping records for 7 years.
Sounds like a common theme is being safe than sorry. Two questions to kind of end on. People some may have heard the phrase 1031 exchange. I know I've heard it a lot. It seems to be an issue that has a lot of interpretations depending who you ask. Don't want you to delve into the details right now, but maybe just a brief description or explanation of what it is and maybe what the benefit it can be to somebody selling their house.
Okay. Section 1031 exchanges are also known as like-kind exchanges.
Okay.
These are for the sale of a business property. This does not apply to the sale of someone's personal residence.
Okay.
If someone wants to sell their home and defer the gain and not have to pay tax on it right away, they can reinvest the proceeds. However, it's important to note that they can't sell the house and take possession of the money and then go out and reinvest. The funds have to be held by a qualified intermediary, and they have a limited amount of time after the sale of the property to identify a new property and to close on it.
Okay, great, thank you. And what if I'm going through a foreclosure and I sell my house before it's foreclosed on? Is that foreclosure process impact what I do from a tax perspective?
Well, a foreclosure is actually considered a sale or exchange of property. And you can recognize either gain or loss on that sale depending on the facts and circumstances of the situation. In addition to that, if the bank chooses to forgive some debt, if the debt is greater than the fair market value of the house and some of that debt is forgiven, you may realize and have to recognize COD income, cancellation of debt income.
Okay. Wow. Well, thank you so much for the information. For those of you who have more questions, definitely encourage you to check out Mr. Codington's website. It's at www.tlcpa.net. You can also see the website at the very bottom of the screen there. His phone number, if you have any more questions, 828-684-6994. I know I walked away with more questions. I'm lucky enough that I get him in the same room for me for the next couple of minutes at least. Either way, thank you for joining us today. Be sure to check us out at property-answers.com.